Good morning, ladies and gents, or good afternoon, good evening, depending on where you are in the world. Thank you all for tuning in to another week of what I like to call Mind Over Markets. I'm hoping those of you that are here, tuning in, watching this back on a recording, whatever format you're viewing this in, I'm hoping these are somewhat familiar sessions. If they're not, please go back through the Darwinex YouTube channel, have a look through some of the content that we've been putting out over the last few weeks and months that we've been doing these. Really sharing a lot of nuggets, wisdom, experiences that have all come from pain, lessons, just things that we have learned in the market over the last few years that we've been in this game, and all aiming to help you to become more consistent in terms of your approach and how you engage with the markets. Now, this week is going to be no different. As many of you will be aware, I like to build a lot of these sessions around topics which are either something relevant to things that I am dealing with in terms of how I approach the markets, as well as topics and conversations that I'm having with my clients on a week by week and a month by month basis. I always say I am most fortunate to be able to connect with hundreds of traders on a month to month basis. Part of the work that I do, part of the clients that I work with on a month to month basis, I'm able to have a variety of different conversations, have exposure to a lot of different experiences, see a lot of people's mentality and how their psychology impacts what they do. And I try and frame all of those into one session, which I deliver for you guys 45 to 60 minutes every couple of weeks. And like I said, it's provided for you to be able to become more consistent in terms of how you approach this game. Now, this week, I want to speak specifically on a topic which has been very, very relevant for me over the last, I would say, 7 to 10 days or so. I've had a pretty slow start to the year. I closed January minus 0.3R down. I only traded a couple of weeks of it or so, but been very, very conservative to start off the year. And I'm going to start putting my foot on the gas a little bit more as we get back into this month and going forward. But I ended January basically flat. You could call it slight loss, but I would frame that as flat. It's what I tell myself to help me sleep better at night anyway. And we have started February equally, I would argue, very, very slow. Now, last week, I actually had quite a challenging week. And it's a lot of where the idea for this week's topic has come from. Now, not challenging in the sense that I struggled with execution or drawdown or losses or FOMO or maybe any of the normal things that you would think of when it comes to a psychology and a performance session. The reality is I actually remained flat for the entire week. And for some people, that might be very, very normal. For some people, that might be seen as an insane amount of discipline. And for some of you, maybe you're somewhere in the middle. Now, I don't say last week was difficult largely because I was flat. I actually didn't take part in, I would say, a couple of good opportunities that were presented my way. But I was flat largely because I didn't feel I was in the right headspace to be managing risk in the markets. And that for me is a very, very big factor that I put a lot of emphasis on. And I think it's something that I see not a lot of people actually doing a lot of, at least consciously. And so this is something that I want to speak to you guys about this week. I want to talk to you really about the difference between what I like to call mental capital versus your financial capital. I want to talk about why they're important, ways in which I utilize these sorts of strategies and thought process, and how it helps me to remain consistent over time. Now, again, I want to preface this, much like I do with most of the sessions that I host here. I always like to be transparent and come across correct as part of how I host these. And I like to share that I'm not the world's best trader. I'm not perfect in any way, shape, or form. I'm going to make mistakes. I'm going to lose money. I'm going to go through periods of drawdown. And I think anyone that tells you anything differently from that is probably lying to you. I truly believe we as human beings are imperfect in nature. And therefore, there is always more that we can do. There's always another level up that we can develop and grow into. And there's always a way that we can be better. So me being here and presenting this for you guys today, I'm not speaking from a place of, being on a pedestal by any means. I'm simply speaking from a place of experience. And these are things that have helped me to improve and to grow and continue to do so over the last few years, as well as all my time into the future. So take these on board with an open mind. Every session that we host here is all aimed to give you just a new perspective, a new train of thought, a new way of thinking about a problem, and a new way to help you, again, as always, to level up and become more consistent in terms of how you approach the markets. So I want to share a few things with you guys. If you guys do have questions, comments, feedback, anything that you would like to share, for those of you that are live with us on YouTube, you have the ability to comment in the chat, and I will keep an eye on the conversation. And I'm happy to answer things either throughout the course of today, or maybe we'll do a little bit of open Q&A if there are any questions toward the end of the session itself. So make sure you come and say hello. If you're in the chat, it'll be great to see a few names and faces, or I guess maybe just names in this format for those of you that are actually live. So I want to start off by talking about, I guess mainly I see this as the type of capital that most people tend to ignore in this game. And I say this again, not from a place of ignorance. I say this because I was this person for largely the first few years that I was in this game. I tend to view capital in two forms, right? Those two forms start off with financial capital. This is the one that I think is most obvious. It's the one that people are most aware of, and the one that most people pay the most time and energy towards, right? It's your money. It's your account balance. It's the one that most people are concerned about. It's the one everyone wants to compound and grow. It's the one that people want to protect. And it's a very, very important form. I would argue it's your deepest and most important lifeline as part of what we do. I heard an analogy many, many years ago, and it's something that I've taken on board, and it's something that I share quite often. I wasn't smart enough or poetic enough to come up with it in this way, but it is most definitely a true reflection of what we do in the markets. And it's this raw idea that we as traders, we don't work for a living. We take risk for a living. And that's a very, very different thing, right? We as traders, we can't decide to go to work with $0 in our account and actually come back at the end of a day with more money in our pocket. It's just not possible. It doesn't matter how low of a barrier to entry this industry has now been able to produce. But the one thing that always remains static is, in order to make money and to really survive and thrive in this game, you have to be able to risk a certain amount of capital if you want to be able to make money. So, in any typical job, you bring with you your skill set and you're able to go out and make a living. I can get up, if I was a teacher, a plumber, an electrician, a mechanic, an engineer, a doctor, a lawyer, whatever it is, I can rock up to work with no money in my pocket. And simply by providing my skill set, I have an ability to earn money. However, as a trader, you're not blessed with that same privilege, right? As a trader, you require all of the same things that is needed for every other industry, meaning a skill set, some expertise, some knowledge that you can share to exchange for some value. However, what you are also required to bring to the table is capital, right? You're required to bring either your own capital or investor capital in some way, shape, or form to be able to grow, compound, use. And it's a form of tool. It's a tool. It's a form of leverage, I should say. Without that, you don't have any means to work. You could be the absolute best trader in the world, but if you don't have capital to bring with you into this game, whether that's because you don't have any of your own, you don't have investor capital, whatever means you're choosing to utilize, you're not going to be able to go to work. You're not going to be able to make any money. And so financial capital is well and truly your lifeline. Now, the side to this that I would add is the second type of capital that I think most traders actually truthfully just ignore, or they don't put enough time, energy, and emphasis on, is your mental capital, right? And for me, this is where I look at things in terms of clarity of mind. This is where I look at things in terms of your level of patience. This is where I look at your ability to be able to regulate your emotions on a day-to-day, a week-by-week, and a month-by-month basis. I think protecting your money and obsessing over that area is important, right? For everything that we do here, we're nothing more than just glorified risk managers. That's always the way that I like to look at it. we do nothing more day in and day out than manage risk on a day-to-day basis. It's not about prediction. It's not about forecasting. We're all going to be wrong at some point in time. This game is purely surrounded around the idea of how much are you going to make when you're right versus how much are you going to lose when you're wrong. If you learn to master that skill set, then actually succeeding in this game becomes a possibility, and which is something that not a lot of people get to do. Again, I like to keep it real. I like to remind a lot of people that actually being successful in the markets, the odds are quite heavily stacked against you. And a part of that is, yes, there's a knowledge, there's a skill set that's required, but largely because it's a mental game. There is a big part to what we do here that in our ability to be consistent, in our ability to manage risk for a living, we have to take active measures to protect our mind. And I believe this is true whether you're a discretionary and manual trader or whether you have an automated approach to the markets. I have seen people on both ends, which from a lack of clarity of mind has impacted their performance and therefore skewed the returns that they should be getting from the market. For me, the reality is that whilst money is, yes, of course, vastly important, and we've already said it's a massive lifeline in this game, the reality is you can always rebuild your financial capital over time. The problem that I find most people have is because they don't put enough emphasis or energy on their mental capital, once that level gets depleted and you can't think and see clearly anymore, your execution absolutely collapses. And so if you don't actually take the right proactive steps to look after your mind, then actually your financial capital is going to suffer as a result of the lapse in judgment that you're bringing with you into this game. Okay. I tend to find, at least when you start unpacking most people's problems, and this is essentially what I do for most of my living, is I tend to find that when most people have these blow up moments or they underperform for an extended period of time, you can often trace that moment back to a time and a place where they have not put enough time and emphasis on their mental capital. They haven't regulated their emotions well enough. They haven't thought well enough in probabilities. They haven't zoomed out and thought over a large enough sample size. And so I find that a lot of traders, whether it's their personal capital, whether they're playing in prop firms, whether they're going down the route of trying to treat this a little bit more professionally and manage investor capital like we're doing here at Darwinex, they tend to not lose themselves and their accounts because they ran out of money. They lose them first and foremost because they've actually run out of mental capital to begin with. And so I think the more time and energy that you put into managing your mindset, the better the odds are going to be that you can actually start to improve your ability to manage your money for a living. And that's a really, really important part of this game. Okay. So I'm hoping that's clear for most people. I'm hoping you guys are starting to understand why this or today's topic is quite important for part of what we're going to be doing in the grand scheme of your aspiring or long careers in this game. But it's a very important aspect that I think is not spoken about enough. And it's an area that I always like to put a lot of time, emphasis, and energy on. Okay. Hello to the star. I can see you said hello here on YouTube. Thank you very much for tuning in. Like I said, and I want to reiterate, for those of you watching this live, you have full capability of taking advantage of the comment section. If you have any questions, feedback, challenges, things that you're going through, things that you would like some help and assistance with, please feel free to leave a comment on today's stream itself. I will get through all of the questions either on the stream in and of itself, or I will come back to them towards the end of the session and give you guys some feedback on that. Right, let's actually start breaking into today's topic. I actually want to start by talking about specifically what I mean by the two types of capital that we've discussed today, right? We've kind of glanced over this at the very start of today's session, but we've talked about financial and mental capital, right? Financial capital, again, I'm hoping this is the obvious one, but this is essentially your account balance. And most people put emphasis and energy into this area by worrying about maybe their risk per trade, maybe their weekly or their monthly allowance that they're going to give themselves in terms of how much capital they're going to expend. Maybe they're concerned with this in terms of drawdown limitations. Maybe it's just a pure reflection on your actual position sizing per trade. There are a variety of different ways to tackle this area. No right or wrong way. I find risk management is a very, very shade of gray area. I think that you could take a perfectly poor or inadequate strategy, and with good, careful risk management, you have at least the ability to get it to a point where it's maybe breaking even, right? That's how important I think risk management can be. And on the flip side, you could take an amazing strategy, and simply by having poor risk management, you can make it lose money over time. That's how big of a difference I think risk management can be. There are 1,000,001 ways to go about it. The key is finding something that works best for your strategy, your edge in the market, as well as you as a person. Now, on the flip side to this, we've also discussed and opened today's topic with the idea of talking a little bit about mental capital. This is your ability to focus. This is your ability to regulate emotions. As we touched on previously, this is your patience. This might be your level of confidence. This might be, and I think one of the most important aspects is your ability to make good quality decisions in a timely manner. This is something that is, I think, very, very overlooked in this space. We as traders, we don't get paid for our analysis, unfortunately. I would love it if we could all sit here in hindsight trade and analyze where the market was going to go, and we could get paid as a result of that. But the raw reality is we get paid to make good quality decisions. If you have the best analysis in the world, but you don't have an ability to use that analysis in real time and be able to make decisions where you're putting money on the line to actually capitalize on those ideas, then your ability to make money is absolutely zero. And that's also not what we want either. So what I want you guys to understand and take away from this is that your ability to be successful as a trader over a large sample size of time is really about finding a balance between these two things. Yes, of course, you have to be a good risk manager. You have to manage that financial capital. But a big factor that goes on to determine your ability to manage that financial capital is your mental capital. It's that mental state of mind that you have to be aware of. And often what I find is that level of mental capital, it's invisible. It's not a number that is represented on a screen like you can look at with your account balance. If you get into a position today and you make or lose a few % of your account, it's visible. You can see that. Unequivocally, most platforms will tell you that, hey, today you are up X% or you're down X%. It's very, very black and white. However, mental capital doesn't tend to have that same reading. There isn't just something where you could check in with mentally and you could say, hey, today I'm at 48% performance and therefore I'm going to decide to not trade today. I would argue that it's actually more difficult because your mind will trick you. It will lie to you. It will make you believe that you're in a good state of mind when actually you're completely in the wrong state. And that's what causes you to blow up in most instances. So I think your mental capital it's going to be tested throughout your day, and it's your job to develop a system and a process to actually check in with yourself to understand how that's going to impact your performance over time. And this could happen in a variety of different ways. It might be forcing a trade. It might be overthinking. It might be fighting the market. It might be just taking a trade whilst frustrated or fatigued, right? Sometimes the issues that traders have in the market ironically have nothing to do with the market. It's issues that they've had in their personal lives, their professional lives, and they bring with them those experiences that, again, end up clouding their judgment, and it has an impact on how they perform over time. So the key takeaway, at least from this little subsection here, is I want you to understand that often financial losses, periods of drawdown, times with hardship and things like this, they are often a result of mental exhaustion or a lack of clarity in your mind. You can still have money left in your account, but you could still be mentally bankrupt. And that's not a position that you want to be playing from, because at some point in time, that level of emptiness or cloudiness in your mind is going to spill over into your performance. So you as a trader, whether it's aspiring, whether you're already profitable and you're looking to take yourself up to the next level, this is something that you have to be prepared for as part of longevity in this game. Okay. So I'm hoping, again, that's clear for everyone. I'm hoping you guys are starting to understand the importance of this. And I'm hoping it's something that you're starting to think a little bit more about. We've got a couple of comments here from YouTube. Using my wife's YouTube account, but my name is Malcolm. Welcome, Malcolm. Thank you for being here. Last year, I started a new job, and for 3 months, I wasn't in the mental space to trade, and that had a huge effect on my returns and my performance. Malcolm, I mean, definitely something I think a lot of people can relate to. Unfortunately, I think for a lot of people, we only recognize these with hindsight, right? We only look back over a period of time and we say, I wish I had, the awareness that I have now to just tell myself it's okay to take a step back over this time. But in the moment, we tell ourselves if we're not actively taking advantage of opportunities, we're getting left behind. We're missing out. There's money to be made and I'm simply not doing it. I always like to tell people, or at least remind people, that you could have the most perfect setup that happens in the markets. It could tick every box that you're looking for. But if you're not in the right mental headspace to take advantage of that, it's going to have an impact on your ability to either execute, manage, or exit that position. And that's probably going to screw you over at the same time as well. And this is exactly why I've built today's topic around this, because what you've described there was such a true reflection of my reality last week. The only difference is I've learned through enough pain over the years, and that's just me being honest. I've learned through enough pain that when I'm not in the right headspace, it's probably not a good idea to be trading. My reality last week was, and again, for context of anyone that hasn't tuned into one of these before, I split a lot of my time between actively trading, but mostly I spend it doing exactly this. I spend it coaching, whether it's group coaching, whether it's one-to-one coaching. I do it in a variety of different formats, all aimed to help traders with their performance. Last week, I had a very, very busy week when it came to my business and my coaching. I was traveling. I wasn't sleeping enough. I was changing time zones. And the raw and honest reality was I just didn't feel like I was in a good headspace to manage risk in the markets. So when I look back at the markets towards the end of the week and I look back at how things had moved and I compared them to what I would have liked to have done at the start of the week, I definitely missed out on a couple of positions. Now, does it suck having to miss out on those situations? Of course. But I look back at that and I accept that there could have been one of a couple of situations there. Either I could have pushed myself to try and go through and, take advantage of those opportunities, and that maybe would have worked out. But I truly don't believe that's going to be a habit that is going to pay me in the long run, right? Forcing myself to try and operate at optimal performance when I'm really not with it. It may have worked out on that occasion, but I believe, and again, I take this from my experience, that over a large enough sample size, that's going to be something that costs me rather than rewards me over time. I choose to believe that the likelihood is that, yes, I missed out on a couple of opportunities last week, but by not forcing myself to get into the markets, I have done myself a service, right? And that service for me is largely preserving capital. And I think not enough people look at it that way. I think a part of being a good risk manager is understanding that sometimes the best position that you could take is just sitting on your hands and just waiting and observing for both the markets to align for what you're looking for, as well as you being in the right headspace to actually take advantage of those opportunities. The moment that I understood that largely a lot of this game is just about sitting and waiting for my edge to appear, both mental edge and edge in terms of the markets, my outlook on what we do in this game really, really changed over time. And so I think that's it's a lesson for everyone. It was most definitely a lesson for me. And a lot of my time now, especially when I understand that if either the markets are not in the right place or I'm not in the right place, I'm trying to actively do things to preserve my mental capital. And again, being real with you, I now haven't traded for a week. I'm mindful that I'm more likely to have that sort of itchy trigger finger to want to be in the markets. And I found that today, getting into the markets, I was, waiting for opportunities to set up. And in a passing time, I went on to Twitter. which is where I probably spend most of my time on social media. And what you tend to find on social media is always the same narrative. It's always the highlight reel of what people are experiencing. It's everyone posting their profits and the trades that they've been in, and people sharing that the markets are easy and you're an idiot if you didn't take advantage of this easy opportunity. And all that does is really just drive FOMO, right? And when I realized that, hey, this is going to be the narrative of today, the markets have opened a little bit busy today, but some people may or may not be in these opportunities. But if my ability to be in the market is not there, whether that's strategic again or mental, I have to learn to be mindful of what I'm allowing my mind to be exposed to. Reading, my timeline over and over again today is honestly only just going to drive FOMO. And so I decided I need to turn off. I need to do something different. I need to detach and just be patient to wait for my edge to set up. Whether that turns out to be a winning trade or a losing trade is honestly irrelevant, right? I just want to make sure that when I am getting into the market, I trust I have done so because my edge is strategically present and mentally I'm in the right place to take advantage of that as well. So yeah, I don't know, something to think about, but I could definitely resonate with what you're saying there, Malcolm. Definitely starting to realize that about managing capital on this level. Less is more and sitting is more common than I realized, 100%. This is honestly why, and again, I'm obviously going to be biased with what we're doing here, but it's why I like having or listening in on sessions that are just like this. Because at least from my experience, a lot of what you see online about trading is nobody talks about the idea that actually trading can be quite boring. It can be frustrating sitting on the sidelines and not having a setup. And until we normalize that, until we, help people to understand that you don't have to be active every day, to make money as part of this game, then, it's a very, very difficult game to play when you're allowing yourself to be fed all the wrong types of information that are not going to allow you to perform optimally for your edge. It's just a very, very challenging game. So, take from that what you will, but I'm glad you can resonate with this. It's definitely up my alley as well. We'll comment from save your unit link. In my opinion, in Darwinex, if I use a permanent one lot all the time, wherever the balance, and rely the money management to the Darwin risk engine, is that enough? I would take this a little bit from a different angle, right? You have to remember that the risk engine, it's designed to help preserve capital over time, right? And that's going to be aligned with what the market should produce over a given period of time. What we're trying to do here is essentially protect investor capital, but that should give you the freedom to essentially trade however you like, right? The risk engine is essentially either going to dial up your risk or dial it down based on a level from what it deems based on your performance to what is going to be optimal over time, so that you don't lose too much money when you inevitably go through a period of drawdown, right? It's trying to find the optimal level of risk for you to kind of maximize that upside as well as minimize that downside. It's designed to work for you. And this is why we often encourage not resetting your performance here on Darwinex. It's all about building a long track record. And the more the Darwin can get to understand how you perform over time, the better it's going to be for your performance in the long run. So I would say, in all honesty, if I was in your position, I would trade at a risk level that you are comfortable with and that aligns best with your strategy, and just to allow the risk engine to do its thing. Whether it feels the need to size up or size down, it will learn and adapt over time. But I think don't overthink and try and optimize to work in a way that's best for the risk engine. Focus on doing the thing that you should be doing, which is trading to the best of your ability. If you can do that and you actually have an edge in the market in the long run, the risk engine will work for you rather than against you. And it's not something that I think you need to overthink as part of how you're approaching this game. That's my understanding and takeaway from it. Take from that what you will, but that would be kind of my thought process on how you're thinking about this. I hope that's of some help for you. Okay. Right. Let me loop back to what we were talking about today, right? Going back to this idea of mental capital. I want to talk about, I think, a few very, very common ways. And again, this is going to resonate a little bit with what I've been talking about over the last week or so as to how most traders fall into a trap of actually depleting their mental capital over time. And I think it's good to be aware of some of these common traps, largely because, as we've already established, your mental capital doesn't have a reading, right? It's not like your account balance. You are in charge of understanding where your level of mental capital is. And if you're not aware that it's being depleted over time, that's going to be something that works against you rather than for you. So some really, really simple ways that I tend to see, and again, some of these are my own experiences, some of these are ones that I see in my clients on a month-to-month basis. The first one, and I think a very, very common culprit, is actually overtrading, right? And when I say overtrading, I'm not talking about a specific number. I always like to make this distinction. I don't believe overtrading is a specific number of trades. I believe overtrading is trading more setups than your strategy has actually presented. Everyone's edge is going to be different, right? For some people, you might get 10 good opportunities in a day. I might get 10 good opportunities in a quarter. I don't know, right? I'm just throwing it out there to show the differences in how your edge is represented over a week by week and a month by month basis. Now, the problem is, I find that when you are taking too many setups, especially ones that start falling outside of your trade plan, I tend to find that most people experience a certain level of decision fatigue, right? And this is exactly where was this? Malcolm mentioned this in the comments, right? This whole idea of less is more. What I tend to experience, and the way that I have learned this best about psychology, is we as human beings, we have a finite amount of good decisions that we get to make each and every day. I don't believe we have an infinite supply of them and we can use them at work, with family, with kids, with our parents, with our spouse, with our siblings, and then we can go ahead and make 100 good decisions in the markets as well. I believe that we have a finite amount. I believe our mind works more so like a battery rather than anything else. And like every battery, there is a certain point in time when that battery gets down to a certain level where performance becomes suboptimal, right? I have an iPhone. Those of you that have a smartphone, you will probably understand this idea. When my iPhone gets onto, less than 20%, 10%, and I switch it to low power mode, it doesn't work the same way. When it gets to 1%, things are sluggish. Things open and close very, very slowly. But at 100%, it performs amazingly. And so we have to remember, as human beings, when we wake up each and every day, we likely start with, and I say likely because it's not this way for everyone, but we likely start with close to or at 100% capacity when it comes to our ability to make good decisions. Now, again, there can be a variety of factors that change this, and some people won't wake up with 100%. But for a lot of people, you wake up with at least a higher percentage than usually what you probably went to bed with. Now, for us, as part of what we're doing here, thinking about ourselves in terms of risk managers, we have to remind ourselves that the market doesn't really care about your frequency of trading. Whether you want to take one trade a day, one trade a month, 100 trades a week, it doesn't matter. The market does not care about how little or how active you are getting involved in the markets. However, your nervous system, your mind, your psychology, your ability to, make all those good decisions, that does. Like I said, the first decision that you make in the day and the 100th decision that you make in the day are likely to be very, very different when it comes to clarity. And so for you as a risk manager, you have to be very, very mindful of this. You have to understand that if you have 1,000,001 things going on, whether it's work or family or kids or your boss or your neighbors or, colleagues, whatever it is, could be 100 things on your mind. Whatever it is that's playing on your mind, it's going to have an impact and it's going to drain your ability to make good quality decisions. Now, that could be outside of what happens in the markets, but equally could also be due to things like overtrading. The more and more you get in and out of a trade, every single one of those requires a decision. Your 10th trade of a day is probably not going to be as clear mentally as your first trade of the day. And that's something that you have to be mindful of, right? So you guys have to be very, very conscious about this idea. And especially those of you that have a trade plan, that allows you to take multiple positions in a day. And I'm talking specifically to the scalpers, the intraday traders, maybe that are going to be taking multiple positions day in and day out. On average, I'm taking somewhere between maybe 1 to 3 trades a week. Sometimes maybe it's more, sometimes it's less. But I'm mindful that with my approach, my progress or my activity is probably a better way to phrase this. My activity is a little bit lesser than most other people. And therefore, my ability to make good decisions, generally speaking, is usually quite good, right? And it's one of the reasons that I choose to trade a little bit of a higher time frame. By that, I mean, I'm not on a 1 minute or a 2 minute, 5 minute, 10-minute chart. They just move a little bit faster than what I would prefer is maybe the best way to think about it, right? But overtrading taking multiple trades in a day is definitely something that you want to be aware of from a mental capital perspective. We have a finite amount of good decisions. Your ability is, you have to be able to prioritize doing the right things and making sure that you have enough mental capital for when you really need it. The second trap that I find a lot of traders fall into is emotional trading. And again, let's all be honest here. We've all done this at some point in time. I'm most definitely not immune to it. It's something that I've got quite good at doing far less of in today's day and age. But like I said at the very start of today's session, I'm not perfect. I'm not advocating that I'm, this superhuman trader. I'm sure there are going to be times and days into my future where I do trade impulsively, emotionally. And it's just part of being a human being. But, those days when you revenge trade or you FOMO into the market, or maybe you're trading just to fill, boredom that you're experiencing, not necessarily to execute at the best of your ability, but just because you want some excitement as part of your day. This is all emotional trading. And again, it eats into that mental capital that could be better spent on better opportunities over time. Okay. The last couple that I find a lot of traders tend to fall into in terms of traps when it comes to depleting your mental capital. I always kind of label this as poor risk hygiene, right? Sounds like a funny way to phrase this when it comes to trading, but poor risk hygiene. And for me, this is how you manage risk after a position. And sometimes for some people, that might be increasing their risk on the next trade because they've had a last very good trade. For some people, it might be sizing down or being too cautious, maybe not even being able to execute at all because their last trade was a losing one. So it's carrying the baggage of your previous trade, previous day, previous week into what you should be doing ideally this week. And that's, again, something that you really want to be mindful of. So you need to be careful about how you go about managing risk. And the reason I call it kind of, risk hygiene is every trade or every day that you come into the markets, you want to be able to kind of wash yourself free of what has happened previously. Whether it was a good experience, whether it was a bad experience, remind yourself again, the market doesn't care about what happened last time. The market doesn't care about anything, right? It doesn't care about the amount of capital that you're trading, your hopes, wishes, or desires. It doesn't care about how much money you want to make. The market just moves. Our ability to apply meaning to everything that the market does is where most people tend to go wrong. So you want to think about this, right? You want to build that kind of reset in, and you want to be able to wash yourself free of previous experiences. The last thing that I would add to this, and again, this is one that I could probably resonate with most, I would say this week, is most people don't have a recovery protocol, right? And for me, that recovery protocol is they don't understand the right time to take a break. They don't understand the right time to actually sit down and reflect on their performance. They don't have any system or process to reset their emotions between sessions. And I see this all the time, right? And again, not just in myself, but in a lot of other people as well. Whether you're trading a personal account and you're unable to recover from, a loss or a losing streak, whether this is in your Darwinex account, right? And you're not able to recover from a period of drawdown. And that's, I would say, an optimal skill that you need here, because this is all about building a long-term track record. whether it's, whether you're someone that manages all of these things in alignment with, the modern day prop accounts that we tend to see, and you end up losing all your funding in one go, right? You have to remind yourself that this is, just an intro into some of the most common patterns that I see. But the underlying message here is that your mental capital, it leaks invisibly. It leaks quietly. Again, you don't have that balance that looks you on the face every single day like you have when you're looking at your account balance. If you're not aware of your mental capital being drained, one day, one moment, one trade, you're going to realize that it's gone. And your ability to do the right thing is really going to suffer in that moment. And the moment you lose the clarity to be able to manage risk in the way that you would like, you're going to struggle as a trader. You're going to struggle to have longevity in this game. And that's something that's, again, always going to work against you. Okay. Now, I think the part that I want you guys to really be mindful of, and one of the big messages that I want to share with you guys today is, we've spoken a lot about the difference between financial capital and mental capital. What I want you to understand is, whilst they are both equally important in their own ways individually, they are actually very much connected, right? Financial drawdown, when you go through it, when you've taken a loss, going through a losing streak, had a losing month, whatever it is, that naturally is going to drain your mental capital. Everyone has a limit, right? Whether it's, for some people, it might just be one losing trade. For some people, they might not feel anything until they get to 2 or 3 months worth of losses in a row. I don't know, right? But if you're not very, very mindful of this idea that financial drawdown drains your mental capital, you're not going to be aware of the loop that starts to create. And that is, the moment you go down into mental drawdown, it also starts to create financial drawdown, right? It becomes this self-fulfilling vicious cycle. And this is where I find most traders tend to go wrong. They actually come into the markets doing all of the right things. They prioritize the right things. They look for the right opportunities in the market. And what happens? They have one loss. That loss is a natural part of executing their edge. It's nothing that they need to overthink, but they do. And the moment that happens, they start spiraling mentally. And one loss turns into a second loss. And then it drains their mental capital even further. And then the third and the fourth trade, for example, they're trades that are not even aligned with their plan. And then that creates a whole new world of problems that you have to start to fix in the long run, right? So I always say to most people that you need to understand this relationship between your financial capital and your mental capital. I always believe that when your mental capital is high and you have good clarity of mind, you're much better at respecting risk. You have a higher level of patience going forward, and you're more likely to be able to think in probability and accept the short-term randomness and uncertainty of the market. However, on the flip side, when your mental capital is low, you're more inclined to rush. You're more inclined to overtrade in the market. You're more likely to abandon your process and therefore throw all your rules, processes, and systems out the window. And so what you have to start to understand is that the market doesn't necessarily test your strategy first and foremost. It tests your mental capacity. That first loss that you take that is completely aligned with your plan, that's your first test. If you haven't got good at dealing with that, if you haven't accepted that from the get-go, it's going to be something that works against you. And again, that lack of mental capital is going to start having spillover issues in your ability to manage your financial capital. And that was, that's the big one we need to really be aware of. Okay. So what I want you guys to start understanding is, as we've already relayed, your mental capital is very, very finite. It can be impacted in a variety of different ways. We've talked about some of the common traps, but some other ones that I want you to be aware of, because I've kind of alluded to this idea that your ability to perform is not always impacted by simply things that happen in the markets. You have to also be mindful that your mental capital could be drained by also stress, poor sleep. That was definitely me last week. Pressures in other areas of life, more screen time than you probably need. For some people, it's little things like just too much exposure to loud noise. Again, I'm not judging by any means, but they all have an ability to impact how clearly you can think on a day-to-day and week-by-week basis, right? So I think we all need to get better at prioritizing our mental capital. When you start understanding this vicious cycle that we all live in, you have to understand and start doing things, which is really what I want to share with you guys today, certain ways that you can start prioritizing that mental capital. And that's going to improve your odds of actually being able to manage that personal capital over time, right? What I tend to find, and again, this is something that I'm continuously working on, but I see this in traders that are operating at the highest level, right? That I've been, fortunate enough to meet. The best traders at that level, they don't trade until their mental capital is at zero. They stop long before that happens. The moment they realize that things are starting to work against them, then they start prioritizing, doing things in a way that prioritizes that mental capital. And that's what allows them to survive in the long run. Now, I want to share with you a few things that I think will help you to protect that mental capital. If you can resonate with some of the things that I've been sharing today, I want to give you a few tips, a few words of advice from, again, my experience, things that I have picked up in working with many traders over the years. And you want to be mindful of these things on a day-to-day and week-by-week basis, because these are what going to allow you to protect that mental capital over time. Okay. The first one is, I think it makes sense to set up some type of filtration system, right? When I'm talking about a filtration system, I'm talking about a system which helps you to understand what state your mind is in before you go ahead and make a decision. Now, I find most traders have some kind of filtering process when it comes to deciding whether they should be in or out of the market. They have a certain list of criteria. They're looking for certain things to happen to allow them to actually warrant getting into a position. Not enough people actually stop and they ask themselves, am I emotionally in a good place to have risk in the market? Not a lot of people are asking that. Not enough people are asking themselves, are the conditions really, really clear that this is, a no-brainer opportunity that I should be in the market and actually utilizing some capital here to see if I can make more of? Again, not enough people are starting to ask that. For some people, it's just a really simple question to sit and reflect on and ask yourself, is this position that I'm taking actually aligned with my plan? For some people, this only happens in hindsight. They end their day, they look back at the trades that they have taken, and they realize that actually, trades 1 and 3 were perfect. They were in line with my plan, but trades 2, 4, 5, 6, 7, and 8, they were garbage. They did not align with my plan at all. And I just justified them in my head, but they weren't actually part of what I was supposed to be doing. So create these pre-trade filters. They can be, as we've mentioned, strategic, making sure that you have this kind of checklist or filter system that shows you the list of criteria that needs to be met from a strategic perspective that allows you to get into the market. But equally alongside that, check in with your mind. Ask yourself, what are you thinking? What are you feeling right now? Are you in a good headspace to actually be able to manage risk as part of what you're doing? Because if you're stressed, if you're under pressure, if you're tired, if you're not thinking clearly, these are all going to be things that work against you once you've got money on the line. Because make no mistake, you might be somewhat objective now, but the moment there is something at stake, the moment you've got money on the line and you've got something to lose, all objectivity tends to go out the window. Everything that you did have remaining, it will go out of the window. So you want to be mindful of this before you even begin. Prioritize that mental capital, and that's what's going to help to make you a better risk manager in the long run. Okay. The second aspect to this, and again, I tend to see this as a common theme for people that are doing this at the highest of levels, is you want to prioritize making fewer but higher quality decisions. And this is where we go back to this idea, exactly like Malcolm shared towards the start of today's session. Less is more, right? Trade less, watch more, wait for longer periods of time. Just wait for everything to align. I always like this analogy that I believe trading well is really just about waiting for low-hanging fruit. How low? Low enough that if you walk by, it will hit you in the head. Sounds ridiculous to think about it that way, but I always like to think about the trades that I am taking. I want them to be so obvious that they've literally hit me on the head and they are impossible to ignore. I want to be able to look at them and be like, it was so screamingly obvious that this was part of my plan, and it seemed so likely that the trade was going to go in this direction. There is no reason to not take it, right? The way I heard it phrased best is, one of the best mindsets to have is you want to come into this game thinking that your job is purely just to sit and observe the markets. And only when you've lost all reasons to be on the sidelines, that's the time to get involved, right? Your job is not to trade. Your job is not to be active and clicking the button 500 times a day. Your job is to sit and observe. And if you do that really, really well, then when the high probability opportunities present and you've lost all reasons as to why you should be on the sidelines, that's the only time you should be getting involved in the market. And it's been a philosophy that has worked really, really well for me. And again, I think thinking of your activity in the market in that way can be very, very beneficial. Okay. The third point, and one, again, that I have got a lot better at over the last few years, weeks like I've described, like my week was last week, I would typically, 5, 6, 7, 8 years ago, I would have tried to have pushed through. This is something that I'm being a lot more mindful about. And I think in all honesty, this is not a flex by any means, because I'm still on my path to trying to make my millions from the market. But I think actually the more money you end up managing over time, the more you will start to naturally become cautious behind what you do. And I think that could actually be a benefit to a lot of people. I suffered for many years at the start of my journey. When I first funded my own personal account, I funded it with £250, which is, $330 odd dollars. That was the size of my first account. Back when I started, it was a lot easier to open an account and get very, very high leverage on what you were doing. So you didn't need to deposit a lot of money to be able to trade in the way that you would have liked. The problem is, what I suffered with is what I like to call small account syndrome, right? Small account syndrome is you put in a lot of time and energy into something, but you realize the reward that you get at the end when you have a profitable week just did not feel like worth your time. I was at a stage where, I had $300 odd dollars in an account, and, a good winning trade for me was a few bucks. Was it worth waiting an entire week if I was using good risk management to earn that? Probably not. So I always think that the right amount of risk is somewhere between an amount that you're able to sleep okay at night, but not enough that you're going to be so worried and paralyzed about doing anything in the markets, right? You have to find that balance for yourself. And this is where, for me, it introduces this idea of have boundaries with your energy, with your risk, right? Understand what that boundary is, whether it's the amount of risk that you're willing to take and be comfortable with. Maybe specifically for some people, it's going to be a boundary in terms of how much time and energy you expend into the markets. One of my personal red flags that I like to be aware of is I know that if I'm looking at the charts for too long, that's a bad sign, right? I tend to experience, and I see this in a lot of other people as well, the more time you spend on the charts, the more you will create an opportunity which really does not exist. And again, that process starts to drain your mental capital. So I like to fix things for specific periods of time. The nature in how I trade, I don't specifically trade sessions or windows of time. I know that's quite common with scalpers and intraday traders. They want to focus on volatility and having the most volatile sessions. And again, completely understand that. But I like to have trading windows in the sense that I'm very, very mindful about when and how much time I'm spending at the charts throughout the day. My lowest time frame for analyzing a market and executing is the 1 hour chart, which means really and truthfully speaking, there's no reason for me to be checking the charts apart from the end of every hour to make sure there's nothing that I'm going wrong with. I have experimented using a 4 hour chart, but otherwise it's really just the hourly and the daily chart. Outside of a few minutes throughout the day, most of my time should be spent end of day. That's it, right? If there's nothing clear for me from a daily perspective, I don't really want to be in the markets. So you can introduce these boundaries in a variety of different ways. Your own risk tolerance, Maybe you're going to have maximum trade limits for yourself. Maybe you're going to have specific windows of time, whether that's specific sessions, whether it's actual blocks of time during your day, whether it's how much time you want to spend analyzing the market. You can create all of these things, but I would say couple them up with a break, right? After you've had some type of mental, emotional expenditure in the markets, in your personal life, create that boundary, right? Have a break from the market. And this is what I was trying to do a lot of last week. Very quickly recognized that I wasn't in an optimal place to be thinking and probably doing business and trying to manage risk for a living. So I decided I was basically just going to stay flat. Unless I had something which absolutely screamed and shouted off the top of the roofs that this was clear to take, which it didn't, and that probably does not happen very often, I decided it was going to be my best use of time to just be flat for the week and keep it there for the time being, okay? The last thing that I would say about protecting your mental capital is you want to be making sure that you're keeping a good journal, right? One thing that I've touched on time and time again as part of today's session is your mental capital does not have a number that sits in front of the screen that you're visible to. It happens invisibly over time. And so I think journaling is a great way to make the unconscious conscious. It's a great way to make the invisible visible. So you want to be tracking your emotional state. You want to be tracking your ability to focus. You want to be tracking your ability to make good decisions. Journals are not just for hindsight reflection. They are actually for detecting patterns proactively, right? When you can start to realize that I don't have the same ability that I had last week to, focus in the same way, that's a red flag, something to be aware of. That's an indication that maybe you should be taking a step back and questioning, why am I slipping up? Why can't I focus the same? Why is my process, not flowing as well as it normally does? These are all things that you really, really want to be aware of over time, okay? So some quick tips there to just protect your mental capital. If you're somebody that is constantly going on the other side, which is your mental capital is depleted, you're doing all the wrong things, you're not in a place where you have enough awareness to detect that early enough, there are a couple of things that I want to briefly touch on before we wind down today's session about actually rebuilding your mental capital, because I believe this is a skill that we all need. I stand here as a performance coach that prides myself on my ability to be able to recognize these things, to do the right things in the moment. But like I said, I'm a human being. I'm not perfect. I'm mindful that I'm going to make mistakes. I'm going to slip up at some point in time. Your ability to be able to recover from those moments are equally as important as your ability to protect them to begin with. And that's, again, not something not enough people put focus and emphasis on, right? Mistakes are going to happen. You're going to slip up. What matters is not making that mistake something that continues so that you end up having this one big blow up moment that you can't recover from. Just to remind you guys, right? If you lose 50% of your capital, you need 100% return just to get back to break even. That, for most people, is psychologically impossible, right? The amount of psychological resilience it takes to double an account and realize that you're just back to your starting point is very, very difficult. You know what's easier? Not losing it to begin with. So having this reset protocol to actually take a step back and rebuild your mental capital after a small mistake is key, right? I truly believe that mental capital can be rebuilt, but it doesn't happen instantly. The same way in which your phone can go down to less than 10% battery and you can't just snap your fingers and bring it back up to 100%, it's going to take a period of time, right? Now, technology has evolved so that our phones, or most modern day smartphones, they now have quick charge, right? You can get 80% back in the space of 30 odd minutes or so. This wasn't always there. And I always like this idea as an analogy of how we improve over time in terms of our psychology. At the start of your journey, when you're getting better at prioritizing your mental capital, sometimes it might take you a full 24, 48 hours to get back to equilibrium, right? A place of balance where you can see things clearly. At the start of my journey, it was almost like a full week before I could honestly come back and say, I'm at a place of balance. Nowadays, give me an hour. I could go from being really, really pissed off, really frustrated about the market. You give me an hour, I can reset that that kind of perspective, I can take a little bit of a break and detach from the markets a little bit. And I can come back in usually good enough shape to make good quality decisions. It's not always something that I like to do, and it's not something that I necessarily have to do. But if you are someone that, again, trades intraday or you scalp, it is something you can improve over time. But it does require certain things. That might be time away. It might be reducing your exposure to certain things. It might be lowering your expectations. For me, your first goal after a tough period in the markets, it always has to be about just getting some stability back. It's not about profitability. It's not about recovering losses as quickly as possible. For me, and the way, again, I always heard it poetically put, and it's the philosophy that I adopt in today's day and age, the first step to recovering from financial drawdown, mistakes, issues, errors, lapses in judgment, you have to start by recovering from the mental drawdown. The moment you get good at creating that space, giving yourself that perspective, having that little bit of time away, the quicker you can recover that mental capital and recover from that mental drawdown that you're experiencing, the more likely it is that you're going to be able to recover that financial capital in a much quicker and much more efficient space of time, right? So keep that in mind. Your job after drawdown, it's not about making money. It's all about getting yourself into a headspace where you feel safe and confident to execute your plan again. Because making money should always just be a byproduct of doing exactly that. Just executing your plan. Sometimes it's going to win, sometimes it's going to lose. And that's going to be to varying degrees depending on your win rate in the market. But it is entirely your ability to be in control of this. You have to take charge of this. You have to be responsible for this, especially, and again, for those of you that are the mechanical, the discretionary traders, the ones that choose to be there, the ones that are actually clicking the button. It is entirely on you to give yourself this stability in the long run. Okay. So I hope you've taken some perspective away from this. I'm hoping you're understanding that, trading is not really what it's glorified as in social media, in my opinion. It's not, daily profits and killing it all the time and never going through hard patches. There is a big part of this game that is mental. And sometimes that's to do with things in the market. Sometimes it's not. But it is entirely your responsibility to build a process, a system, a level of awareness that helps you to understand where that level is for you and to prioritize that as part of what you do as being a good risk manager. That's how you win in the long run, right? I have not yet met a trader that completely neglects the idea of doing things, whether it's consciously or subconsciously, to prioritize their psychology and keeping a good headspace. Some people are better at this than others because they've been raised in a way, they have a belief system and experiences that allows them to do this. But in my experience, and the statistics support the idea that most people suck at it. Most people are not used to the dynamics of playing in a probabilistic environment. They're not used to taking losses. They're not used to having to manage their mental capital as part of what they do. And that is truly why I believe that most people will always lose in this game. That is it for today, right? Thank you guys so much for tuning in. I genuinely really appreciate every single one of you that's been here. Those of you that commented, left some questions, some feedback. Very, very much appreciate it. Again, for everyone that is watching this on a recording, again, appreciate you guys being here. If there are any questions that you would like to throw my way, if it's on a future session, you're more than welcome to either attend one of these, throw them out inside the YouTube chat, or if you would like to throw them in the Darwinex Discord, I am present in there. You could tag me in the Discord, shoot any questions my way. I will collect them. I will bring them to a session, and I will give you guys some feedback on them on these calls in and of themselves. Okay, that is all for today. Thank you guys so much for your time. I hope you have an amazing rest of the week ahead. Be disciplined, stick to your plan, and manage your mental capital. Final words of wisdom for today. Thank you guys so much. I'll speak to you all very, very soon. Take care, my friends.